Good afternoon, everyone, and thank you for joining us. Um, what we're trying to cover here today with my esteemed panelists here is how a mall going to sustain and be profitable as the challenges we already understand from the today's market, various challenges that we're facing. However, mall business, as we see, and with the current market environment, is going to be a sustainable format. We all agree to that. But we have an eclectic panel which not only discusses or manages a large portfolio as well as the standalone developments. So the key here is to how to make those developments sustainable, which not only sustains the development, but also fuels future growth. So that's the key of our discussion here today. And as I said, we have industry leaders to give us the right perspective for this particular topic. And I would just go around the table to start with, and start with Nitin here to ask him his two key topics or key factors which makes a mall maybe profitable. Nitin.
So, more from a finance perspective, a mall becomes profitable the moment retailers have more consumption. I think it's something which probably we'll all agree. I think I will talk about more before the mall is constructed. So one is very strong location where you have a strong demography. And second is a good brand mix. That's what attracts the customer.
Yeah, thanks. Thanks, Saket. Jatin, Goel from Omaxe. I think Nitin rightly summarized. It's totally the trading density of a property that governs the profitability of it. And there are various factors to it. As he said, location, the product mix, the right catchment, the right kind of audience that comes over there. And today, I think more than the right availability of brands, it's also about the right experience. A person goes out today in the world of e-commerce for the experience of going out. There are three places that we understand in real estate. The first place is your home, where you stay at. The second place is where you go for working. That's where you spend majority of your time. And then in today's busy life, people want to go to a third place, which could be a mall, which could be a park, which could be any recreational place. So today, profitability would remain about creating those experiences which can gather more and more people to come spend their time, enjoy over there. That's the same concept I think retail stores are working with. As a mall owner, that's the kind of thought that we are trying to establish with the retailers within ourselves as well.
Please, Munish.
Yeah, basically, if you look at mall profitability, there are three things which we can look at. One is the tenant mix. Second is the tenant adjacency. In a mall, which brand is beside which brand? The third is how do we use the 4R formula? Now, 4R in any mall is how do you relocate a brand within a mall if they're not performing to the optimum? How do you resize a brand? How do you resize a store if they're not performing the adequate trading density? How do you remove a store? If a store is not doing well, though they are paying you their desired rentals, you have to take a decision to remove them. Why you need to do that? So that the trading density and the mall remains fresh. And the fourth part is how do you rework on the commercial arrangement? It's very, very important how do we structure our commercials with these brands. That determines the overall long-term profitability of any mall. So it's actually a science where you use a lot of data analytics to really review the brand's performance in a very granular level and then determine how to strategize with that brand in the mall. So that will be my point of view.
Good evening, everybody. They've already added most of stuff, but I think what we're missing out is what we look at is customer centricity or customer engagement. Your brand mix, your location, your entertainment is all what the customer wants. If he wants A and you're giving him C, it doesn't work out. It's all what the customer perception is, what he wants. If you deliver that, you get your profitability. Whether it's your marketing events, your trend mix, your brand mix, your entertainment, what are we offering? It's what you offer is the customer perception, read it out, give it what he wants, do a customer engagement, you have a profitability coming out. Customer could be internal or external. Could be your retailers or the clients who are coming and shopping at your place.
Basically, how you do the catchment of the people and coming their place, and the how the retailer can get the place in a good price. How you if you give a good reasonable price to the retailer, he will pass on his money which is balanced to him to the customer. Customer more will come there and give the profitability to the mall. That is the thing.
Majority of the things are covered, like apart from customer centricity and engaging with customers, bringing in loyalty. Two things, two dimensions I would like to add. Before we, the day you start conceptualizing in the mall, when you're conceptualizing the mall, whether all the papers related to the land and all that is there or not. After that, the statutory approvals, and third is the timelines, how fast you are constructing. Once you are able to manage your cost in these things, then you are able to handle your viability to a large extent, because every year's delay basically impacts your viability for a longer period of time. The second aspect which I would like to highlight is that obviously you should have the best of the mix, best of the wide variety of brand mix. When you look at mall, the majority of the footfall comes only on the weekends. That's almost 50% of the footfall comes during the weekends, and balance 50% comes in the balance 5 days. But all your infrastructure is planned and it is there at peak level for all the 5 days. How do we extract the maximum out of the same space? There are two basically dimensions to it. First dimension is space, which is already there, and second is the time. How can we, extract the maximum footfall during this period? And for that, we have to create many small micro products, small markets. You have to get people in the mall, even during early morning hours, afternoon, late evening. Whether we are able to do that or not, that's what we need to see. For that, we need to understand what the catchment people, what the people in the community, what in the vicinity are looking for. Even if it is in the wider catchment, we have a mall in Siliguri where we have customers coming from primary, secondary, tertiary, and furthermore. Some people come 5 times in a month. Some people come once in 4 months and 3 months. And the catchment is determined in such a way, but the planning of events, planning of multiple activities is done in such a way that if we are organizing for that micro market, for that set of consumers, they should come to our mall. And whenever you are able to get their time share, pocket share is basically it's a simple economics. So this is what I would like to highlight.
Munish, you made a very interesting point, wherein, especially in a stand-in development, which you understand, and Nitin sitting next to you would also can weigh in, is how important that it is for you as somebody who's running a mall as standalone development to be hands-on with your partners so that it's a long-term sustainable model for them as well, so that they don't come back and sort of ask for a lack of a better term, a rebate, or help them in some way so that their business kind of continues to grow. At the same time, an additional point to that question would be that you also, as a mall owner and a developer, need to keep an eye on how you're growing as a mall with regards to the finances. How do you balance that out is what I'm trying to understand here.
So, Saket, that's a very valid point. As a mall, what we generally tend to do with all our partners, we really work with them at a very granular level. We do a lot of analytics in terms of what their performances are at the end of the month. So we do a category-wise analysis, who are in the top 3 or who are in the bottom 3. And then when we realize that there are certain brands which are in the bottom 3, we put them in the PIP. So there was one brand where we put in the PIP. PIP is Performance Improvement Plan. And when we put that brand into PIP, we realized that in next 3 months, they started doubling their sales. So it's just like how we do our appraisals in our organizations, we did the PIP performance. So they started realizing that, there is somebody who's already watching you. And what we do every month, we send to all the categories. So if there is sports category, we send the sports-wise performance to Puma or Nike. So they know where they stand relatively. And we do it on a monthly basis. So that way, they know that we are watching them. And basis that we are also able to work with them in terms of making their format bigger or reworking the arrangement, reworking whether they need a resizing or a relocation or reworking the commercials also. So we do a lot of mid-negotiations also. That is how we as stakeholders, where our KRA is to see how to maximize profitability, at the same time have a sustainable cash flow. Because it should not happen that we increase the rents to such an extent that the retailers are not able to justify. So we have a very strong eye on the rent revenue ratio. That is, we keep a check on the occupancy cost. So when we are dealing with the brands, we really understand from them what is your sales projections. If you're going to do 10, 15 lakhs, and we know that our rentals are this, we know his occupancy cost is going to be 30, 35%. We know he's not going to sustain for long. So we look for those operators who have a strong sense of what kind of businesses you will do and how you will be able to justify those numbers. Then it makes very easy for us to demand that kind of a premium for our real estate.
So my follow-up question here would be when they come back to you and ask for some assistance for them to really perform. Revenue share, I'm understanding, is one bit where you support them with. Is that correct when you go ahead?
Yes, we do that on that. But you know, our support to them is more of motivational, more of doing analytics, because you know they end up asking for, say, branding support or this support, which obviously in a mall like ours where we are, that branding inventory itself is of certain value. So obviously then we have to do a little bit of deep dive in terms of their product mix. Is your merchandise fresh? Is your operations teams in place? What are you doing to make your store more relevant? Is it jaded? When did you do the last renovation? It's just like doing a deep dive into their business, which they understand and appreciate from where we are coming from. Because at the end of the day, we want them to make money. Because if they are going to make money, we are going to make money. So idea is that.
Fair point. Nitin, coming to you. So revenue share definitely is a large part of the deal structuring today. Not only in terms of giving assistance to them when you're, come back to the developers for their sustainability, but also as a primary deal structure when you deal with certain category of brands, right? And you definitely want them in your development. When you go to your banks, from your finance point of view, does that help you? Does that an easy sale with the bankers saying, hey, you know what, I have this, but we're very comfortable with the brand and their business projections. Does that fly with them? And if not, then how do you really end up securing it?
So, I'm sure everybody understands LRD well. And I think banks have been traditionally looking at what is the history. And then, normally, the moment construction finance is getting converted into LRD, the first thing they look at is, what's the history. And if there is no present history, they actually go back and look at which of the brands are already at, existing brands, established brands, and then they actually give LRD on that. So to answer your question, purely on revenue share, if there are brands on pure revenue share, then probably we have to go and show the history. Banks don't actually go purely on revenue share. So like, Mukesh and Nitin, they were asking, the brands, if they're performing well, it's actually a good news from an LRD perspective. If they're not performing well, and if somebody goes and negotiates a better revenue share, from a bank perspective, it's not a great deal.
Fair enough. So you're saying ultimately, at the end of the day, you have to show numbers on your book. Right. Fair enough. Pramod sir, coming back to you, you have a large portfolio on the eastern side of the country, and you hold some of the assets. You're trying to grow now as we speak. We had a chat before the session, and you were telling us what you're really trying to do now. Some of the assets that you hived off during that phase, and those phases were different. The avenues were not as many as they are today with regards to how do you secure funding in order to fuel future growth, right? Retrospective, if you have to look at it, if you were to be in the same situation with 5-7 developments now today, would you have exited back then? In today's context, or you would have continued to build that platform?
The simple answer is no. We wouldn't have done that. But obviously, you become intelligent once you have made the mistake. So we're talking of almost 20 years ago when we were, when we made our first mall operational. That time, nobody had imagined that REIT will come and these kind of platforms you can exit. That's a very, very good situation. During this period, you had many, either layman and all that, many and COVID. So every time you get into some kind of crisis, it teaches you many ways. But having said that, the kind of, financing options which exist in today's market, which was not there earlier. So one can easily say that the answer is no, because the kind of work which you do, whether it is the strata sold mall or whether you are owning the 100% of the mall, it is the same, because in our case, that's what we do, and we are able to still manage and control, and all those who invested at that point in time are making tons of money. So that is one good part, that we are still able to control the strata sold mall also, because we have a large setup of mall management company. We have been doing that. But the second answer is that had we kept the entire portfolio, obviously situation would have been completely different. But when we learned this, after that we have stopped doing that. And all our future plans, in all our future plans also, we are considering in everything, self-financing and obviously LRD and other kind of financial options.
Jatin, I'll come to you with the same question. We had a chat right before this session as well, where you also have a large retail portfolio which you sold initially to start with, of course, need of the hour. You're now looking at a next growth phase for your retail assets, integrated with other asset classes. And this is your very clear this time that we are going to build a platform, we are going to build a large portfolio and see where it goes. Would you answer similar to what Pramod said? If you could use that mic, please. Thank you.
No, actually, my answer is absolutely the opposite. Because I think cash flow is the bread and butter of any business, right? Now, if you're doing one business today, how do you make money off it, put it elsewhere, is what defines an entrepreneur, which gives a better return elsewhere, right, today. At the same time, if you're talking about profitability models for malls, right, there's one strat sale model, there's another leasehold model that malls are working in. In both the situations, the properties still operate and still work. Today's environment is very different from what it used to be, let's say, 10 years or 15 years back, with respect to what the customers want. There was no e-commerce back then. The kind of competition that is over here is next level. At the same time, the funding opportunities are very different today, right? So 10 years back, are you asking me that should I not have sold the strata malls? I probably 100% answer is yes, I would have. Is why I'm sitting over here and still delivering more than 4 million square feet of commercial asset already. Having said that, I want to now move into the leasehold model because experience is everything now. And without really controlling the experience of a third place, as I said earlier, which is a mall, you cannot really, get the kind of profitability in there. You need to have control over your tenants. You need to have control over your common areas. You need to see what kind of audience is coming. I would like to talk about one special project, which is kind of different from all this model that I'm talking about, which is Chandni Chowk. So we got this project years back.
I need to give a quick brief for the audiences to understand what the project is.
So Chandni Chowk, I'm sure everybody understands the location, is the center of Delhi, so to say, old Delhi. And it's the largest wholesale and retail hub in Asia. At one point of time, it used to be 25% of global GDP trade would happen at this location. That's what Chandni Chowk is, and still is today Asia's largest wholesale market. Now, because of the development that has happened since the Mughals, since the Britishers, since the independent India, the infrastructure has changed away from the city, and no redevelopment, no parking projects have come over there. Now, this is the first time in 300 years that we have got an opportunity to work with the government and redevelop a piece of land and create parking space over there. At the same time, we are redeveloping a mall over there as well, while keeping the same tenants who are already in Chandni Chowk and bringing in the fresh talent inside a property is what we're doing.
Because you already have the benchmark of those people historically doing very well for the last 200 years.
Yes. Now, we did have a thorough discussion about this particular project, that should we do the strata sale as we've been doing earlier, or should we hold this property for the longest time and continue monetizing it? But then we realized that the market is already behaving what behaved 10 years from now. I am getting the same today that I would probably get 10 years from now, because it's a mature market. It's not a suburb of Delhi that I'm going and I will invest 10 years of my time and the value will become more. So it made sense for me to sell today.
Fair enough. That's a very fair point. I'll come back to you, Nitin, again. I mean, what we are seeing here is that what we did 10 years, 20 years back, that was the only way to cash out, only way to be profitable. things have, of course, changed leaps and bounds now, right? You have better avenues, and things are slightly more organized as they were, right? So what are those exit models now you have available for developers like yourself who are now in the next phase of growth again and going to really develop large size malls back again?
So,
Or let me also add one more to it. Would the portfolio become so large that there's no exit option anymore?
look, it's while I was discussing with Jatin and we were talking about, so it's a difference between profit and wealth. So what's your purpose of creating an asset? Whether you want to monetize it, get the profit right now, or you want to create a wealth, make it, long term and take an exit maybe at 10x later on with an investor coming in and take an exit at that point of time. I think REIT is of course the one you've seen that today we had the first retail REIT getting closed at 1.7x. So I think these kind of models are giving confidence to the retail investors as well as somebody who wants to invest in real estate but probably doesn't have that kind of deeper pockets. So indirectly, even as a retailer, as investor, I am holding some amount of real estate in that. From an investor perspective or a promoter perspective, it's also a great avenue for exit. That's one bigger thing. Second is, you can still go for an IPO. We have seen some real estate IPOs, where they are shopping malls, shopping centers. Plus, we have seen mixed use also, coming to IPO. So it's a mix and match. It also depends on what kind of portfolio you hold. So if you have a growth portfolio where there are a lot of under construction assets and you want to monetize it, I think IPO might be the best route. From a REIT perspective, you have seen matured market. You see a yield which has an history. You can give a confidence to the retail investor, show them tax benefit, and then you can go for that model. I'm sure REIT, of course, is very nascent here. It's already grown in Asia quite leaps and bounds. I'm hoping some new models do come up, in the coming future. I think these are the ones which probably I can think about. The third part, which is more of an investor, coming from abroad or through an AFI model, DFI model, or AIF model, and then they want to invest. You want to don't get listed. You don't want to, monetize. You have that option available as well.
Pramod, you agree with what Nitin is saying with regards to the various avenues that we have? Is that what everybody is now looking at when they create the portfolio?
He has explained it very nicely. I think we are on the same page. He has explained it very nicely. I think we are on the same page.
Would you have the same vision with your portfolio going along?
So we are contemplating in many ways. We are yet to come up with an answer at the moment.
Fair point. Nitin, I'll come to you on the profitability bit again. I'm taking Nitin and B together because we have two Nitins and two Khanna on the panel. Yeah. And so therefore, coming back to the question, Nitin, from what Munish explained as to how you really need to get hands-on, and we spoke from the various aspects as to how to make it profitable at a macro level, but at a micro level, which you do on a day-to-day basis. What Munish said made a lot of sense to me in terms of getting down to the level of understanding their business and helping them make more profitable. But as a mall developer, apart from rental, what other avenues or what other revenue stream that you can think of which can actually help the profitability of the mall? And also, are there anything else that you're thinking which maybe not have been done before?
No. For profitability, we work the similar way what Munish briefed out. So it's a two-pronged strategy. One, we look into what we already have, the brands, the tenant mix, and one, what we can achieve from outside. So once all the stores are leased out, you have a fixed income, which is there, you cannot make money. So other one is you get down to the grassroots like we discussed, do a business review, make it out, make them rev share profitable, do promotions and make it up money from them extra than what is budgeted. The second one is when we do it, look at what the customer wants. The perception, we do the events, the promotions, the marketing, the selling of the sites, your digital marketing stuff. And sometimes even we go down and put a flea market. When most of the malls do, despite the fact you got 200, 300 stores, we still end up doing flea markets, every mall does. So it's what the need is. We use that for making extra money or profitability because you already got a fixed done. Whatever makes a customer wants, you deliver to make extra thing. All the promotions, the events, the parking and stuff. It's a big thing, but you have to break it down into a P&L head. Because when you do a sites and on the malls, every mall has an outside coverage where you have sites for marketing, promotion. You have a license fee and it varies from various parts in the country. There's a different rules in south, different north and west. So the profit basic rules remain the same, but depending on city, we work on differently for different margin availability. But the ground rules are the same. What Munish, Khanna Sahab, and everybody's wanted. The ground rules remain the same for all of us.
Absolutely, absolutely. Coming to you, Prakash, you're on the verge of opening a mid-size center in the outskirts, which used to be in the outskirts of Mumbai, maybe not anymore in coming future. And it's a very interesting project that you're developing. Maybe you could talk about that a bit more. Because you're at the verge of it and you know from where your rent is going to start and the center starts becoming profitable, even though the land cost may not be as great for you because you've held on to that asset for a long time, but you still have to provision for it for the opening few months to ensure the rent start, and for you as a developer, it becomes profitable in such and such date. Do you provision for that when you start a mall?
So basically, the idea is to. I have already 150 acre of industrial park behind this mall. So idea is to the catchment nearby to us. Tata Mantra is there, Godrej is there, Mahindra is there, Lodha is there. These all people are making residential project with the strength of 35 to 40,000 homes in next 2-3 years. These people, where will they go for the shopping? Second thing, there are lots of Bhiwandi people where they have not having the access of to go to city malls, and they have deep pocket for the expenditure because they have given their land for the development and they are getting the warehouse. In that warehouse, against they are getting the rent per month. They have fixed income of that particular area land bank, where these people are having good size. As we were discussing, sir was saying, when you are creating supply, demand will always be created in that particular space. So in which where we are confident that we'll be able to justify the brands to that particular area, and they will also make profit. And because of them, we will also make the profit, and we will make brand comfortable for their expenditure. So we are basically very much nearby to the maintenance part of the any mall in Bombay. That is the CAM charge is equal to our rental in our mall. So it is the same. So we will be able to, and there are case studies in our area. We already started one Tata Zudio. Zudio is already started operating from 4 months. And that was his target was about 30 lakhs per month. He on the 4th month he got 80 lakhs. So people around that area are having good capacity of buying, and because of that, see, customer will buy more. The retailer will earn the revenue, and if a retailer will earn the revenue, he will definitely give the rental in a good time to the mall owner.
Yes, please.
That is a perfect example of the leasehold model where the upside is, so much out there. And he's saying the rental is equal to the CAM itself. So that's just wanted to add.
No, absolutely.
There is only one catch in this, more from a finance perspective. So when you talk about a revenue share model and you work very closely with the retailers to increase their sales, I think it's important to go back and see the agreement also. Many times what happens, we normally push the revenue share, but it reaches up to only a certain level. So I think it's important to relook at our agreements and keep getting the revenue share in the rentals. So 33 months, make sure that revenue share is actually in the fixed rentals and not continues in revenue share as it is.
Because
it's
now
more
there's
of a variable thing.
Right. Because now you have a reference point
Absolutely.
that you absolutely save with your business. No, absolutely all fair points that you have made here. I'll come back to you, Munish. I mean, he mentioned CAM, which sensitive topic. I'm not going to touch too much upon it. All I'm trying to understand here is maintenance is a large cost for the developers, for the retailers, and somehow it also, of course, passed on to the end consumers as well, right? When you do your budgeting with regards to your churn for the next year or for the next season, or whatever churn is happening, do you factor in a large portion of that with regards to when you're discussing with a certain kind of retailers which were wanting to come to your mall? Do you do that analysis saying whether this model fits or not? Do you filter that as well when you do that? Both from the rental point of view, because as I said, your rental needs to also keep it hitting. I mean, somebody come and says, okay, 500 rupees fine, I'll pay right now, but after first escalation, it might not be as viable. And it's not a good scenario for anyone in that situation. how do you fend for that?
So in this case, what happens that it's very important for us to understand the brand's business model, and we also have to be updated at what the industry is doing. Just like how a stock market investor should know what company is he buying, what businesses are they in. Similarly, as a mall developer and into leasing and maximizing the revenue, you need to understand the brand's business. And then work out the cost structures, because if you get an argument from the retailer that the cost is very high, obviously because you are also looking into his P&L and you're talking his language, that is of occupancy cost. What is my rent to revenue ratio? Why am I asking you to pay me 10 rupees higher CAM? If I'm asking you to pay me 10 rupees higher CAM, because I know that because of annual inflation, your sales will also go up, and because of the new product lines or new freshness, your sales also have to go up. Because it cannot happen that my cost is going up and his sales are not going up. Because that point of time will come when he'll say that business is not sustainable. So while I have to be realistic about my cost, because I have to maintain my mall to the standards which I want, and there are a lot of other statutory escalations, at the same time I have to factor that when I'm doing my churn analysis or dealing with the other tenant. Because if we both are not aligned, there will always be this gap that you are asking us higher rentals and it's not becoming viable. There could be an exception where we are obviously taking a deviation, that we are not asking that. And there could be a reason for that, that brand is going to add a lot of freshness, especially with the F&B category where we know that the GSTs do not get a set off. There we give them a lot of leeway and comfort. So I think that kind of fine-tuning is very, very important to ensure that that energy in that mall is intact all the time. That freshness, that energy, it becomes a buzzing consumption center.
Absolutely. Nitin, please go ahead.
Just adding on to what he said, as I said initially, it's customer perception and engagement. The customer in this case would be retailer. His perception is low rental, low CAM, and extra pound for him. But in our case, we have to engage with them, tell them what exactly we're spending on. Because we are together, as he said rightly, we have to work together to get money back in and the clients and the footfall in to generate it out. So if we go by one side of perception, so the profitability finance guy, Khanna ji would be after us saying no money, nothing. He's saying read the agreement. But as exactly, it's a very thin line you have to work on day in and day out to work out the driver profitability for both partner and yourself. So it's not only the DNA when you look at it, it's profitability for win for everybody. Not I win or you win, it's win-win for everybody. Retailer and us gives you a profitability at the end of the day.
Since you already have the mic, Nitin, I have a follow-up question for you. Not a follow-up question, but a separate set of question for you. The way the rents are increasing, and we know what kind of trades we personally are doing. We are not going into detail with that. But if that continues at the same level, also considering the retailers that you're giving those spaces to, do you think their business model sustains and the growth sustains for them to keep paying you, incremental growth numbers over a period of 3 to 4, 5 years,
yes,
as things stands today?
Yes, it does. It does. See, we all have to look back and look at it. COVID is gone. We all gave waivers. We all sustained ourselves. We've all come out of it. Today, we all have to work together. Every business model, as I said, we sit down on a monthly basis. That RR ratio, rent to revenue ratio, is what we primarily look at. Whether a guy can sustain today or not, or does he need a helping hand, or does he need a push, or does he need a kick? Does all three have to be defined by the end of the month or a quarter to make yourself profitable? It's not that either one of us bleeds will be bad for us. Tomorrow, if he's a retailer next to me is bleeding out in the store, I'm trying to get a new store guy. He will come and ask the guy, how's your business? He say, मैं तो मर रहा हूँ, तुम भी मत आना. So we do not want that perception to build on long. So we keep doing on our efforts month on month. All our efforts are going right now with every mall. And India is doing more marketing, events, promotions to study that thing. And the way things are going, I don't see any business guy will have a problem for next 5 to 10 years. They can all sustain. They can all sustain if they are willing to. Okay. That's a big thing.
Okay, fair. Nitin, you wanted to add something?
Look, when we look at the KPIs, there's always, somebody has to really look into what kind of KPIs we are looking at. And while we look at rent revenue ratio, many times, many of the players don't add revenue share into it. Many times we don't look at CAM. Many of the deals are pure revenue share deals where somebody doesn't pay CAM. So while you are doing a revenue share, rent revenue calculation, probably there is a mathematical error over there. So one has to be very careful while doing this rent revenue and deciding whether retail is performing or not. So just wanted to add on that.
So you're essentially saying that the clear marker is not very clearly defined, as you're saying right now.
I'm saying, look, at the end of the day, what is mall's consumption? It boils down to that. And when you talk about CAMs separately, it's always a retailer's pain point. I have been a retailer also, so I've worked in retail, so I understand. But normally, from a mall perspective, at the end of the day, it's the profitability which counts. So you want to get more rentals and lesser CAM, you want to adjust in that, it's purely with you. So you have to understand how you balance your profitability in the entire profit and loss. And, give that extra, maybe a 10 rupee or 20 rupee to retail to understand. And if you're fair, and if you have a very strong brand relationship, I think you will be able to mix and match. I agree to what Nitin is saying. Rent revenue ratio is always that, one benchmark for all of us. But, these kind of small tweaks we need to continuously look and evolve. Yep.
Pramod, do you agree with what both Nitin have said with regards to building the revenue share bit of it?
In this case, like we retailers and the mall developers, both the parties should simply believe in only one thing. What is his occupancy cost? Occupancy cost includes CAM also. So why? Because ultimately, this for him, rent and CAM is together is occupancy cost. So if it is, and if majority of the players are not viable, you are going to be in trouble. Finally, you will have to take care of them, because it's not a simple मैंने आज किराया दिया कल वो जिंदगी भर मुझे किराया देगा. Ultimately, unless he makes money, he is not going to be with you. Unless majority of them makes money, they are not going to be with you, because if there is churning in the mall, little bit, a few percentage here and there, that's okay, because that's part of the business. But if it is beyond certain norms, you will not get even the new tenant. And then finally, you have to ensure that the brands which are operating from your mall is viable. And how you control, one is cost, the other is revenue. What is in your hand? Promotion and multiple engagement with consumers is improve the revenue. If he's getting higher revenue, he's happy, both the parties are happy.
I'll come back to Munish, you again, because you run a standalone development, and I'll come to you, Nitin, after that. From what you're hearing, the kind of avenues that are available today to fund growth and the opportunity, and considering India still has a very small number of per capita retail space, so to speak, do you think running a mid-sized to a large-sized portfolio of development is probably be a better bet going forward? Or you think a standalone development can still sustain and still make the mark and be happy with what they deliver from the expectations that they have?
If you look at the way Indians, especially in our country, how the retail spaces are transforming, they are becoming more experiential in nature. You look at the brands also, they are all going for experiential stores. That means they all need larger sizes. And today, malls are not only for shopping. I think it is going beyond shopping. It's becoming like a community space, F&B destination, entertainment destination, for which you need larger than life space like this. Just imagine this convention center where we are. So every city, and especially with the young demographics of ours and the consuming population, it is bound to go up. So what I sense in our country, this malls of smaller sizes will always have a constraint versus, and every city will have someone who is creating the right optimum size for the city, which is larger than life. And when the larger than life mall comes up, it obviously eats up the smaller mall, and which we have seen in examples in cities like. So I think we have to have that kind of configuration in the design stage only, that we are creating those kind of spaces.
Okay, Nitin would like to weigh in.
No, I agree with him totally. See, a small size mall or a mid size is not going to deliver what we are looking for the future. The malls are no more shopping centers or extended bigger. We are destination centers. We are the entertainment zone. We are the eating zones. We are the outing. We are basically the picnic zones now for a family. You don't say, let's go to a garden for a picnic, or let's go to some area, or let's go to a beach. Let's say, let's go to a mall nearer to me, or whichever it is. We are the centers where people are coming or converging to for their day-to-day needs, shopping, and just for spending time out. So a bigger center delivers more for two ways. Firstly, the store size is big, so you got a lot of stuff coming in for the merchandise being displayed, the SKUs coming in. he has a more sale and more paying capacity. With a smaller segment, that gets relected under one. So a bigger one destination, a bigger mall, wherever it is, in tier 1, tier 2, tier city, is a better reach and a better way of sustainability coming into that one.
Jatin, very relevant question to you now that you're...
No, just to, I have a follow-up question over here, just to understand more on, if, of course, what we realize is a bigger concept mall will outdo a smaller concept mall any day. And if we have seen that in your experience, does it make sense for a smaller concept mall to skew towards a particular category and become a differentiator at least in that particular category, or maintain the same product mix that it already has?
No, we have to reinvent. There is no other option but to reinvent. We have to make a smaller one to a bigger one, or amalgamate bigger stores or something. Because end of the day, when you're looking at profitability, a smaller size with smaller stores, they'll have a limited paying capacity. Their sales will remain limited over the years. So your rental expectation will never breach a certain mark. So you can keep doing churns one after another one, but you will not get that what you're looking at the profitable level.
I think we are having a conversation earlier, and somebody told me that there's this concept which is basically food-only mall.
Yeah.
There's no retail, nothing over there. The whole mall is food. So I think that answers your question of reinventing. You know, how would you want to do it?
We have a classic example next to you in DLF's Cyber City, next to you. Yeah. And Prakash was running.
So yeah, there is one mall in Bangalore which is having only 150,000 square feet, only food, only restaurants, nothing else.
So, Jatin, coming back to you, and thanks for taking over for a while. I took a breather. Because you're on the next, growth phase where you experienced the entire strata sold model, now you're looking at a leasehold model, would you rather slowly develop a large portfolio, and not a large size mall essentially, but a large portfolio, and decide what needs to be done with that, and which way I want to go, whether I'm looking to exit and what kind of exit? If not, am I going to hold on to that? Is that the thought now with the future generation of mall developers?
For sure. There's actually a lot of factors that play into this decision. Having 35 years of experience into... We have actually entered a lot of cities. We are in 27 cities in 8 states already. And me and my brother are trying to consolidate the effort that my father has already done. Right? So in Chandigarh and Lucknow, we've got 1,000 acres of township, which is primarily residential. Right? So in these places, we've got a potential of next 30 acres or 40 acres of commercial spaces that we have to build. Right? 1,000 acres of township has a population density of easily 5 lakh, 10 lakh people living over there. How will their commercial needs be satisfied? So it's up to us that do we want to move into the strata sale or a leasehold model into these areas. I believe that those markets complement each other, is why I would want to move into a leasehold model in these particular markets, be it Chandigarh, be it Ludhiana, be it Lucknow, be it Indore for that matter. All these places I'm looking to do that. On the other hand, as I said earlier, Chandni Chowk, which is already a mature, saturated market, I wouldn't want to do that. So that's purely a strategic call for us as a whole group.
Fair enough. Last question to you, Nitin. Looking at the portfolio now that you already hold, and looking at the portfolio that you're now looking to develop, and a lot of people are now doing that, and there are people who are doing million square feet of 10, 12 malls put together. Is that how you see country as a whole going? Because there's a dearth of shopping center, right? There are avenues available. Can we safely say in the next 5 to 6 years, this is the kind of growth you'll see from the large developers, the funds, as well as the local strong players on those regions?
So if I understood the question
also
right,
from the profitability point of view, not just from the increasing the size point of view.
So I personally feel that a small size mall is definitely a deterrent. So I'll start from the size perspective. Look, customer experience has been prominent, and we have seen, we have heard that slowly they are becoming community centers. So if I have to go inside a mall as a consumer, I need a proper access to the mall, how fast I can enter inside the mall, and how quickly I can park. Can I get a parking space? I don't have to be stressed on that part. So once he was talking about a big mall, you have a big mall, you have a big space, and you have an access, and there is an ease, of getting in and getting out. So to answer your question, I think anything below 1 million probably will be a big no. Only thing is, the only catch here is, while I'm assessing a tier 2 or tier 3 or tier 4 town, since, while we are talking about difference between an organized market and an unorganized market, and we see a huge space in terms of unorganized market. Just one, KPI correction, when we look at unorganized retail market, we should actually take out the hyper part of it, which is, the local reseller or the local agriculture sale. So if you take that out, you still have space, but that's not that huge. So when you go to a mall, go to a space where it is a tier 2 or tier 3 town, I think 6 lakh square feet or 7 lakh square feet might be the right fit for that kind of space. You have to also see the decadal growth. If your decadal growth is only 10% population, people are moving out. One factor which is also important for profitability is the political scenario or the economic scenario, both of the country as well as the state. The reason I'm talking about the country is with the recent interest rate hikes, you see my EMI has gone up. As a consumer, if I need to spend extra, because malls are places where I need to splurge. That's the place where there's an impulse buying happening. And that's the reason, we all are here. The retailers actually earn from that. It's not the necessity which, gives me profit. So if I have to go inside and I have to spend, I should have a propensity to spend there. So economic scenario of the country is also helping me to have that, extra, consumption. To answer your question, in next 5 years, definitely we see big spaces coming up, big organized spaces coming up.
Okay. So last question to you, the same question that I asked Nitin. Going forward, you see... All right. All right. Why don't we finish and then we'll wrap it up?
It completely depends on the overall demand scenario in that city and what kind of, land scarcity you have to see. If the land is available in abundance, obviously you have to see that you are going to see a lot of competition. Okay. I'll just give you one example. Again, suppose if the cities like Raipur and all that, one has to be sensitive because tomorrow again you will see 1 million or 2 million square feet of development. But if the cities like Patna or even Ranchi or even Jamshedpur, then you know that the land cost is high and there is a limitation. So whatever best possible, even if you make a larger one, and so that you can be there for the next 20, 30 years, because as it was mentioned that the average age of the consumer is Indian is 27. So next 20 years we are really going to grow very nicely.
Thank you so much. That's all the time that we have tonight. Okay, I don't think we have time for a question, but if you want to quickly ask it, maybe we'll still accommodate. You're good. All right, we can have an offline chat after this. Thank you so much. Thank you for joining us today. Thank you so much. Thank you.